Today we'll be discussing the three major models of lending, non-bank lending. Okay, let's go. The first one is what we call balance sheet lending. And before I go on, I want us to keep something in the back of our mind. As we said, the two types of lending. So any of these models of lending can either be analog, traditional, it can have an analog, you can have analog means, or it can be fintech or digital. Because everything is about the means to which is the means of processing these services. So these services can either be processed through analog or can be processed through digital. It depends on the lender. It depends on what where the lender lies. So going ahead. So first one I said is balance sheet lending. Balance sheet lenders. What is balance sheet lending? Balance sheet lending is where there is a balance sheet, whether it's money or funds, or the lender is giving money, is lending money through his own funds, through his own capital. He has to raise capital on his own, then lend this money. They are the ones that are very similar to banks. The only difference between them and banks is that they don't take deposits. Ideally they should lend money from their own capital, from their own funds, and they bear the risk of credit. The credit risk is on them. If the loan goes bad, everything falls on them. Let me give you an example. I'm sure you've seen different types of, because it can either be a finance company if it's in the federal level, or a money lender which is state level. And whether it's finance company or whether it's a money lender, they can either be, as I said earlier, they can either be analog, where they have a fiscal office and all that, and could use collateral, or they can be digital, where they are strictly online. But this is just a model. This balance sheet lending model basically is, for example, where I have a finance company. I'm finance company A, and I want to lend money, and I lend money to Emeka or Nkechi, and I expect money to be returned. I expect the money returned with interest, depending on what was agreed on. Interest, they put an interest in it, and after a while, the money is refunded or not. But yes, that's the idea behind balance sheet lending. We have a couple of examples. One of the examples of balance sheet lending is Lifesteller. They operate a fintech lending app. Then there is Ivy Global and Investment. Those are more into the whole traditional, get your collateral and I'll give you a loan. So that's that for balance sheet lending. Then the second one is peer-to-peer lending, or market lending. So this peer-to-peer lending, I don't know if you've heard of it. I'm sure it's more or less like it works. The way it works is there's an intermediary, there's a lender, there's a borrower, and there's an intermediary. If it's traditional lending, traditional analog kind of lending, maybe that in the marketplace there's someone, a broker, that can connect lenders to borrowers. So Madam A that is selling fish wants to import more fish. She now goes to the broker. Hey, I want fish. I want to borrow money. Oh. Okay, now broker now will now take her again to Mr. C and say that has money. Okay, now there is Madam A wants money for fish. Mr. C gives this money with interest. At the end of the day, the money is paid back with interest to Mr. A, and that broker will have his own percentage. The same thing when it's the fintech digital lending, as a platform that's an intermediary. This platform set up in such a way that I'm sure we have come across it online. It's set up in such a way that it connects lenders to borrowers. Lenders come on this platform, and borrowers come on this platform looking for loans. Then that they go through the whole lending. You see the one that fits your capacity. You apply. This lenders will now disburse loans if they find you credit worthy. They will now disburse loans to you, add your interest. End of day, payment is made. Sorry, loan is given. And when this loan is given, when the due time comes, interest is paid, and the intermediary is this peer-to-peer lending, will now make his own share, or make his own money. In this one as well, is on the lender, but this one is on one-on-one basis. It's not. It does not have an institution like balance sheet lending. Does not have an institution per se where he lends money from his own capital. The risk is on this one-on-one lenders. Like if Nkechi wants money and goes on the app and they connect her to Emeka, so Nkechi we bear the credit risk if Emeka chooses not to pay, or if Emeka ends up being a bad debt, not the intermediary, not the platform, not the middleman that is bringing two of them together. We not hold the risk. It's just going to be the risk be on Nkechi. That's basically how the whole peer-to-peer lending works. The examples of this peer-to-peer lending is Kia. Then there is marketplace lending, marketplace peer-to-peer lending. This one is the same thing as the peer-to-peer lending, but it's different in such a way that it's more. There are more people involved, and what they call lenders is investors. These investors give whether to businesses, to a group of people, they disburse loans, and these loans are supposed to be paid back, but as an intermediary, okay, you go to an institution, a broker institution, or someone that is doing the intermediary, going to connect the investor to the market, to the um the group of people or the businesses that want this loan. And it's really huge amount, not like a one-on-one kind of thing. This one is when you're talking about a huge amount of money. So you're bringing investors, maybe all these IT, all these tech, and have all these virgin investors or angel investors, and so yeah, you now want a huge money deal. You bring them on board. The company brings them on board, brings the potential IT or potential founders or startups that he should invest in, and he invested. Those that is called peer-to-peer lending or even crowdfunding, but it's, yeah, peer to is peer-to-peer lending, peer-to-peer lending, and it's marketplace lending as well when it's a large group of people. So in that situation, the investor, whether it's angel investor, whoever, whether it's an investor, same way the lender in the peer-to-peer, in this marketplace as well, the investor will bear the risk. The same way the lender will bear the risk, the investor as well will bear the risk. So that's how it works with peer-to-peer lending or marketplace lending. They're both one and the same thing. Even crowdfunding is very similar. Crowdfunding is the same thing as peer-to-peer lending. So we move on now to the third one, BNPL, buy now, pay later. If you're watching football, like watching DSTV, I'm sure you must have been seeing a lot of adverts. I think it's Jumia or something. But yes, in with buy now, pay later, there are three people involved. There are three parties involved. There is the buyer, there is the seller, and the the provider, the BNPL provider, the buy now, pay later provider. So now Emeka again, or let me say, let me use Chibuzo this time around. Chibuzo is a seller. The Chibuzo is a buyer. He wants to buy sneakers, he wants to buy new sneakers. He goes to Jumia. He goes to Jumia to go and buy these sneakers, but he doesn't have enough money. Jumia here is the seller. Does not have enough money. So it's 10,000 naira. He has 1,000 naira. Yeah, but he doesn't have enough money to buy that sneakers. He goes to the buy now pay later provider, and they are the buy now pay later provider now makes that payment to Jumia on his behalf. Then Chibuzo is meant to now continue paying the buy now pay later provider for that signals, paying in installment, and there's no interest involved. Well, that's what they say. But it's always no interest there, except there's the default somewhere. But there's usually no interest involved. You just pay exactly the money that you're supposed to buy that sneakers. You just pay that amount, but just to pay it in installments. Just pay in installment. But if you default, then there are now penalties. So this a lot of ads about it. If you go to Jumia, if you are someone that shops in Jumia, especially, you see like Jumia is one example. You see something like CradePal. CradePal is a buy now pay later provider as well. When you want to buy maybe sneakers, you want to buy shirts or something, you like shops in Jumia. Then you're not able to pay. You go to CradePal, you click on CradePal or something, and CradePal make the payment for you. Then you now make so far you're credit worthy. Now continue making installments to create power, and that's it. And these are the three different models of non-bank lending. Three different. There are more models, but these are the very popular model around Africa and Nigeria. But around Africa, these are the models that are very popular. The balance sheet lending, the peer-to-peer lending or crowdfunding, and lastly, the buy now pay letter. These are three, and I give you explain these three things with the examples and the person that bear the risk. And the buy now pay letter as well, who bears the risk? Who bears the risk is obviously the buy now pay later provider. They bear the risk. Each person default, they are the ones that end up going after the merchant or the seller is already paid. So it's the buy now pay later provider that ends up bearing the risk. And this is the end. And I'll be seeing you next time. This is law, lending, and life with a fine. Like, share, and subscribe. And I'll be seeing you next time. See you on next episode. Thank you.